Welcome guys to the second video in the options trading strategies tutorial series. In the first video, we discussed a simple call or a put trade and what the payoffs look like for the counterparties involved in that trade. Now we are going to delve into trading strategies that will have a combination of different kinds of options. The way I will do this is I will have a tutorial describing the strategy and then a follow-up tutorial where the strategy is used on a chart for real-life trading. I wanted to do it this way so it's not a lot of information just being dumped on you. It's easy to understand step by step. Let's start with the first strategy called bull spreads. The reason we use bull spreads is when we expect bullish action. That's what the bull is for. What is a spread? A spread is when you put on a trade where you have two or more options of the same type. So let's say you pick a stock and you put on a trade where you're dealing with calls of the stock, just different calls of the same stock or different puts of the same stock. It's called a spread. The first one we'll discuss in bull spreads is the bull call spread. The reason it's called bull call spread is we put it when we are expecting bullish action, and then the way the trade is placed, it uses two different kinds of calls, aka two calls with different strikes and the same expiration date. So in this case, for example, we would buy a call with strike K1 and sell a call with strike K2, and the K2 is greater than K1. So at this point, intuitively, you should know that if the strike is higher for the call, it will be cheaper. So if you're buying a more expensive call and selling a cheaper one, we will be giving out some money to put on this trade. Hence, in this kind of trade, we are paying a premium to have the privilege of trading. Now, in this example, let's say we have a stock and we buy the call with the strike 40 and we sell a call with the strike 45. Let's say the price of the call that we bought was $4 and the price of the call that we sold was $2. So in this case, the total premium we have to pay at the start would be $200, which is right here. Now, if on expiration day the stock price is less than 40, both these calls will expire worthless, the one we bought and the one we sold. So the maximum that we can lose is $200. If the stock price is between 40 and 45, the call at 45 that we sold will expire worthless. We don't have to worry about it. The one that we bought at 40, that will have some value. That value would be the stock price minus 40. So if the stock price is more than 42, we'll have some net profit. Otherwise, we would have a net loss because we still have to make up for the $200 premium that we paid. Now, if the stock price is above 45 on expiration, in that case, our profit from this $40 call, the 40 calls would be stock price minus 40. And the loss from the call that we sold would be stock price minus 45. So the net that we make from the combo of these options would be $500, and then we have to pay off the $200 that we paid in premium. So the net profit would be $300 if the stock price on expiration is above 45. If you guys didn't get that, write it down on a piece of paper because this you need to start to understand intuitively. Now, you guys might ask me, why would we put that? Why can't we just buy a call? Yes, you can. If you had just bought this $40 call, in that case, the 40 strike call, you would have, let's say the price was $4, you would have paid $400 in premium. And yes, your max profit was uncapped. You could have made an infinite amount of profit, but that's not realistic. What we do with the spread is we reduce the amount of premium we have to pay, but we also capped the amount of profit we can make. So you're giving up some reward for the potential risk, for some reduction in risk. And that's the reason bull call spreads are done. Now let this situation is where you're the player. You're paying a premium to play the trade. What about being the casino? In this case, you will get a premium for the trade. So bull put spread is, again, you're expecting bullish action. That's why you have the bull here. But the spread is placed by using puts. So same way, you're expecting bullish action. What you do is you buy a put with a strike K1 and you sell a put with a strike K2 where the strike K2 is greater than K1. Now in this situation, at this point, again, you should intuitively know that the higher the strike for the put, the more expensive it would be, which is the opposite of what we had with the call. So you're selling a more expensive option and you're buying a cheaper option. So the net, you will get some money to put on the trade. That's the premium you will receive to put on the trade. Let's see how the payoff structure for this trade would work out. Again, let's say the $45 put is for $4, the 45 strike put, and the 40 strike put is for $2. So initially you sold this $4 option put and you bought the $2 put. So you're making a net of $200 in premium. Now if the stock price on expiration date is above 45, in that case both these puts expire worthless. So you will pocket a nice $200 and be done with it. If the stock price is between 40 and 45, in which case, on expiration, in which case the 40 put is going to expire worthless, but the 45 put will have some value. And that value would be the stock price, 45 minus the stock price. So as long as it's above 43, you will still have some money, you will be a net positive on expiration based on the premium you got at the start. But if it's below 43, then it will start eating away on your premium and you will be a net negative. If on expiration the stock price is below 40, in that case, the put that you bought, that will have a value of 40 minus the stock price, and the put that you sold will have a value of 45 minus stock price. The net value to you would be minus $500. But you got $200 in premium here, so your max loss would be minus $300. So I hope you're starting to understand the payoff structure in these situations. The difference between the bull call and the bull put spread is, in both situations you expect bullish price action, so you want the maximum gain, right? In both situations that's what you want. If you're putting on a bull put spread, you want both the options to expire worthless. The main difference is, in one case you're getting the premium, you're getting money to put on the trade. In the other situation, you're giving some money to put on the trade. And that's the main difference. How to use these spreads, we will discuss in the next tutorial video. But try and intuitively understand this payoff structure and just simply get this idea. If the strike is higher, the put is more expensive. If the strike is lower, the put is cheaper. When you sell something that's more expensive and you buy something that's cheaper, you get net money. That's premium received. Like, these things should be intuitive. So get used to that. In the next video, we're going to apply this on a chart and see how to use box breakouts in combination with premium selling or premium buy.